This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. Well, today we start our journey into year number 2 of the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. And we have a guest today, but we'll get to that in just a moment. But first, before we get to our guest, Patrick, a very quick sort of look at what's happening with the markets this week.
Yeah, so quick hit. We got a key inflation read out of the U.S. Today. Very much in line with what we expected, so much higher inflation. So we're finally starting to see some of the elevated oil prices due to the conflict in the Middle East that started in the month of March. Obviously, they've rolled over, but we had to be able to collect that March and April data to be able to come out with a CPI reading. So 3.8%. That's about 80 basis points higher than where we were prior to the conflict. And we've talked extensively on the podcast about the connection between what's happening with inflation, what will then likely happen with the plans in around interest rates in the US and perhaps globally with the other central banks, and what the correlation is with stocks and bonds, depending on the direction of interest rates. So not surprising that today, the U.S. market, Canadian market, U.S. is down 30 basis points. Canadian market's up a little bit. Both markets are up about the same amount since last week. So both up about a little over 1% since last week. Gold is very much kind of holding in that pattern around $4,700 US an ounce. Bitcoin down a little bit, but still up about 1% for the week. So I would say from an equity and an investment perspective, very flat, but very much to be expected. We knew this inflation reading was going to come in higher. And I think that this is going to carry over at least until September, because the August is typically the highest demand for gasoline. So higher oil prices throughout the summer. So we're going to get this into September. So not to be surprised. We just continue on with no change in terms of our outlook.
In addition to having a look at the markets weekly on the Wealth Roundup podcast, there are opportunities to get all kinds of insight as far as wealth management is concerned. We've had guests on in the past, talked about estate planning and all kinds of other interesting things that people who are just starting or well into their savings and retirement savings journey. And we have another guest today to talk about things related to that.
Yeah, Terry, it's always exciting when we can invite someone else into the Wealth Roundup. So very excited to have one of my partners from BMO Private Wealth, so Eric Leveille. Often when people think of insurance, they think of home and auto. Eric is with our estate and insurance team. Often when we have very complex conversations with regards to how insurance can help from a tax planning perspective, or even insurance as an investment diversification tool, I like to bring in an expert. So very happy to have Eric joining us today. Welcome, Eric, to the Wealth Roundup.
Thanks.
Thank you for joining us. I suppose when people first talk about or think about when it comes to mind with insurance, it's immediately car insurance, home insurance, travel insurance. But when it comes to investment, what are some of the reasons that people come to you for insurance, and maybe an explanation as to, just going beyond what Patrick was explaining there?
That's a good qualification. I am an extension of Patrick's team working at BMO Private Wealth, Estate and Insurance Solutions, which entail life insurance, critical illness insurance, disability insurance. But for today's topic, we're going to focus mainly on life insurance. The three main topics or three main reasons individuals come to me for those types of solutions are: the number one is what most people think about when they think of life insurance, and it's for protecting their family. They may be starting a family, have some debt that they incur. They want to protect the people they care about. And it's common sense to have some life insurance to protect their dependents in case something happens to them, they lose the income, making sure that their dependents are taken care of. That's very common. The least common threads of thoughts follow when individuals accumulate some wealth. It seems counterintuitive given that most people think of life insurance in the context of needing it for their dependents. But when you do accumulate some wealth, there's a different lens that we have in looking at life insurance. And it's not for the traditional sense of using life insurance to protect dependents, but more, as Patrick outlined, for tax planning, tax minimization, estate planning. So the number two reason people come to me is surplus of assets. We can find that out oftentimes through financial planning, noting that there's sufficient assets to cover them in retirement. They're in a high tax bracket. They pay a lot of taxes. The conversation of life insurance becomes useful in the sense that we can look at not term life insurance, which is more appropriate for the number one reason that I described, but now we're talking about permanent insurance. And when we talk about permanent insurance, as the name suggests, permanent stays for life. And when structured properly, what you pay into it grows to a larger value. And it's more in the context of an asset. So a different conversation. When people accumulate some wealth, this becomes another tool that they can make use of. And permanent insurance is exempt from taxes. So when we identify individuals who have enough assets to cover themselves for retirement, are in high tax brackets, we're looking for tax solutions. And permanent insurance is exempt from taxes. What you allocate towards the permanent insurance grows exempt from taxes. So it's not creating taxes to them while they're alive. And when it pays out to their beneficiaries, it goes outside of probate, tax-free to the beneficiaries. So throughout its lifespan, has maintained its exempt from tax status. So individuals, like I said, who are looking for tax minimization strategies, permanent insurance is one way to do that. And by carving out what they're not necessarily going to spend in their lifetime into the permanent insurance can enhance their estate by, again, paying less taxes and leaving more towards the individuals they care about.
So this is one of those things where you certainly want to go to someone like yourself who is an expert. And it's not, I mean, it's a big difference between comprehensive and fire and theft, which is traditional insurance things. When this comes to insurance, I mean, it's all about your estate. What is an estate bond?
So estate bond is a common term that we use in the industry. And when you think of a bond, it matures to its value. Life insurance, when it matures or pays out the death benefit, it matures and pays out to the beneficiaries. So in the context of what I was describing before, in terms of individuals who have accumulated enough wealth for themselves and have surplus, an estate bond would be the concept of allocating some of that surplus into permanent insurance to grow it exempt from taxes and pay out upon passing. And I've got an example here of an individual that we worked with last year who had significant assets, both corporately and personally, had wealth passed on from her parents to herself, was wanting to be a good steward of that wealth, not wanting to lose the capital and wanted to protect that for her children. So she had enough investments to carry her through to retirement all the way through. But she wanted to preserve some of that surplus in GICs, which of course is protective. It's fixed income, but at the same time, it's low interest rates and it's taxed heavily. We looked at allocating $1 million of that GIC that was just coming up for maturity and using that to fund a permanent insurance solution. The net result of that was turning 1 million into nearly 3 million. That again, growth is exempt from taxes. The 3 million is guaranteed no matter how long she lives, and it would go to her beneficiaries directly and tax-free. So it preserves and protects that capital that was built by her parents and passes it on intergenerationally to her children, all efficiently outside of the estate, tax-free. And to match that solution to her life expectancy, she would have had to find a GIC at about 8% to match that solution, which of course is not available in the market. So if you look at this whole solution, it's almost like a strip bond, right? You purchase it for $1 million. The maturity value is $3 million. So an estate bond, the $3 million goes to her beneficiaries and is a benefit to her estate.
So when is the right time to buy? I'm just going to call it investment insurance, I suppose, for lack of a better term, or me not knowing a lot about it. When's the right time to? Is it during your earning years? Is it as you're approaching retirement? Is it after you've retired? When is the right time to look into this?
I have so many individuals who, after I educate them on the merits of permanent insurance, they've accumulated some wealth. Many of them that say, I wish I would have done this 10 years ago, or say however many years ago, 15 years ago. The reality is they're potentially not in the situation to be able to allocate some of their assets into this strategy. So it's more the first thought of the traditional sense of life insurance, where they're protecting their family. But overall, when they do build some wealth, it's a good time to look at these solutions when they have the capacity to doing it. So obviously you don't have the power of going back in time and doing those strategies, but I do have individuals at all various ages that are able or are in a financial position to be able to take advantage of these tools. Obviously the younger the better, but again, it needs to be an appropriate time that fits within their overall wealth plans. And I also have individuals who I've worked with in their late 70s who were able to make use of the strategy. So yes, there's not a set age, but obviously the younger the better. There are some limits in terms of ages, though. Above 85, it's not possible in Canadian marketplace at the moment. Individuals over 80 becomes very challenging. But again, like I said, individuals younger than 80, there's oftentimes a solution.
I would imagine you'd have to go sit down and go through the full explanation, and then obviously on a 15 to 20-minute podcast, we don't have time to do all of that. But what are the opportunities for you borrowing against a paid-up insurance policy?
That's a very specific strategy, and it involves usually the use of, when I say permanent insurance, it encompasses all types of permanent insurance. But when looking at borrowing solutions, usually we're looking at whole life. Whole life is a type of permanent insurance, which accumulates cash that grows exempt from taxes. So again, when individuals think of life insurance, it's typically thinking of something that will benefit others or beneficiaries, but whole life has the additional benefit of accumulating some cash inside that policy that provides effectively a safety net in case they do need access to that cash later on. So cash accumulates exempt from taxes. It grows inside the policy, is not taxable every year that it grows. And there are different ways of accessing that cash. You mentioned borrowing against it, which is a common one that is described. And there's two ways of borrowing against cash values. Your own policy allows you to take a policy loan against the cash. It's an advance on the cash without canceling the policy. And if you end up passing away with an outstanding loan balance, that means the death benefit would be reduced by the amount of loan outstanding. That's one way. It's easy. It's available to you at any time that there's cash. Usually you can get about 90% of the cash value in terms of a policy loan. But with policy loans, if you're in a taxable gain position within the policy, it may incur taxes if you're taking a policy loan. The other way to take a loan against the cash is taking your policy to the bank, and many banks allow you or assign a line of credit or loan against the cash value, and it ranges between the banks. Some go 90%, some go 100% of the cash value in terms of allowing it to use as security for a line of credit. So that's a high ratio. speaks to the quality of the asset because it is guaranteed to grow every year. They look at that as a safe asset to lend against. But compared to a policy loan, a bank loan will not incur taxes. So you can assign the policy as collateral for a line of credit, and you can draw upon that as you choose. If you need it to supplement your retirement income, you can do that. If there's investment opportunities that you want to make use of, you can redirect that, just like leveraging. You're taking borrowed funds to invest in the market. The difference between this type of asset to be levered against is that if you end up passing away with an outstanding loan or line of credit, the executor is not faced with having to repay that loan because the first payer on that death benefit will be the bank, and any residual thereafter, the loan has been paid off, will go to your beneficiaries tax-free. And I've got an example quickly here of an individual, again, that's a very astute advisor that came to me with his client's policy that had accumulated just over $1 million of cash. This is COVID time when markets had dropped significantly, and saw that as an opportune time to leverage their cash without canceling their policy. They took the policy to the bank. We took the policy to the bank and got a $1 million line of credit against the policy, redirected that million into the depressed stock markets. And because the investments were qualified investments for deduction purposes, they were able to deduct the loan interest rate, and interest rates were low at that time. They made their gains years later. Interest rates went up, and they decided to sell off those gains, repay the loan, and now this cash is unencumbered. If they choose to do the same thing in the future with the same conditions, it's available to them to do again. So that's just an example of, again, an astute way of making use of this. And had they passed away with that loan at that time, the executor would not have had to sell assets to cover that loan. The death benefit would have paid that off automatically.
Individual circumstances vary, and it's going to be different for everybody, but that's why they come and talk to you, I would imagine.
Exactly. I'm here to educate first and foremost.
And that's why we also have you here on the podcast specifically as well. So terrific stuff. Eric Leveille, estate and insurance advisor. Patrick, anything to add?
So we're going to be taking a bit of a break from the Wealth Roundup for at least 2 weeks. So everybody can kind of build up some anticipation, kind of waiting urgently for the next Wealth Roundup podcast. So Eric, thanks again for joining. Any questions that come from the podcast that have perked your interest, please kind of direct them our way. And we look forward to getting back on track with the Wealth podcast in the month of June.
Very good. For wealth management and to start your investment journey and find Patrick's contact information, and then in turn get in touch with Eric, you can go to patrickmleonard.com. And that is the Wealth Roundup for the week of May 15th. Wishing you a speedy recovery from your procedure, and we'll talk to you in a few weeks.
Thanks, Terry.
Thank you.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.